If you've ever looked at your retirement savings and thought, okay, but how do I actually turn this into money I can live on for the next 20 or 30 years without running out or panicking every time the market drops? This video is going to give you the answer. It's called the 3-bucket retirement plan. And once you understand it, you'll never look at your savings the same way again. Because here's the problem most people run into. They spend 30 or 40 years saving diligently, doing everything right. And then they hit retirement and freeze. Nobody ever taught them how to actually spend what they saved. Do you pull from your investments, your savings account? Do you sell stocks in a downturn just because you need groceries this month? Most people have no strategy at all. They just withdraw money reactively and hope for the best. That's exactly the kind of uncertainty that causes people to either overspend recklessly or underspend out of fear, sitting on money they earned the right to enjoy. The 3-bucket strategy fixes that. It gives you a clear, simple structure for organizing your money based on when you'll actually need it. So you're never forced to sell investments at a bad time, and you always know exactly where your next dollar of spending is coming from. Let's break down all 3 buckets, one at a time. Bucket 1. The short-term bucket. This is your cash bucket. This is the money you'll need in the next 1 to 2 years for everyday living expenses, groceries, utilities, healthcare, the regular cost of life. This bucket should be sitting in something safe and completely accessible, a checking account, a high-yield savings account, or a short-term CD, not invested in the stock market, not tied up anywhere that fluctuates in value. The entire purpose of this bucket is stability and immediate access. You should never have to think twice about whether the money is going to be there. How much should be in this bucket? A common guideline many retirement planners use is somewhere between 1 and 2 years' worth of essential living expenses. So if your monthly expenses run around $3,000, this bucket might hold somewhere between $36,000 and $72,000, depending on your comfort level and other sources of guaranteed income like Social Security or a pension. Here's why this bucket matters so much. It's your buffer against bad timing. If the market drops 20% the same month you need to pay for a new roof, you are never forced to sell your investments at a loss to cover that expense, because you already have cash sitting right there, untouched by the market's ups and downs. This single structural decision, having a dedicated cash bucket, is one of the most powerful tools for protecting yourself from what financial planners call sequence of returns risk, which is really just a technical way of saying bad timing early in retirement can do lasting damage if you're forced to sell investments low to cover expenses. Bucket 2. The medium term. Bucket, this is your bridge bucket. Money you likely won't need for roughly 3 to 10 years, but that you also don't want exposed to the full volatility of the stock market. This bucket typically holds a mix of more conservative investments, high-quality bonds, bond funds, fixed annuities, or a balanced mix of stocks and bonds designed to prioritize stability over aggressive growth. The goal here isn't to maximize returns. It's to provide steady, moderate growth while protecting against significant swings in value. Since this money has a medium-term timeline attached to it, think of this bucket as the refill source for bucket 1. As you spend down your short-term cash bucket over the next year or two, this medium-term bucket is what gets tapped to refill it, ideally during periods when markets are stable or up, giving you flexibility in timing those transfers rather than being forced to do it on a rigid schedule regardless of market conditions. This is also where a lot of retirees find real peace of mind, because this bucket is specifically designed to weather typical market ups and downs without dramatic swings. It won't grow as fast as pure stock investments, but it also won't drop as sharply during a downturn, which matters enormously when this money represents years you can't necessarily wait out a prolonged recovery. Bucket 3. The long-term growth bucket. This is the bucket most people are already familiar with. It's your growth-oriented investments, typically a diversified mix of stocks, index funds, or other growth assets. This is money you're not planning to touch for at least 10 years, sometimes much longer. Because this money has a long runway, it can afford to ride out market volatility. Stock markets have historically recovered from downturns and grown significantly over long time horizons, even though the short-term path is often bumpy. The whole point of bucket 3 is to let time do the heavy lifting. This is the portion of your money that's actually working to outpace inflation and grow your overall nest egg over the decades ahead. Here's the key insight that makes the entire 3-bucket system work. Because bucket 1 covers your immediate needs and bucket 2 covers your medium-term needs, Bucket 3 never has to be touched during a downturn. You get to leave it alone, let it recover, let it grow, because you're not relying on it to pay this month's bills. That single structural choice is what allows people to stop panicking every time the market has a rough quarter. Your daily life isn't dependent on what the stock market did yesterday. How the buckets work together. Here's how this plays out in practice year after year. You draw your everyday living expenses from bucket 1, the cash bucket. As bucket 1 gets drawn down, you periodically refill it from bucket 2, ideally choosing moments when markets are calm or performing well, rather than being forced into a fixed schedule. And bucket 2, in turn, gets periodically replenished from bucket 3, typically once every few years, again with some flexibility around timing based on market conditions. This creates a kind of financial waterfall. Growth happens in bucket 3 over the long term. Periodically, some of that growth and principal moves down into bucket 2, which provides steadier, more stable positioning. And bucket 2 periodically refills bucket 1, which covers your actual day-to-day life. Each bucket has a job. Each bucket has an appropriate level of risk for its timeline. And because of that structure, you're never forced into a bad decision driven by short-term panic. Why this matters so much more after 60. Here's something critical to understand about investing after you stop working. When you're still earning a paycheck, a market downturn is uncomfortable, but you're not actively withdrawing money from your investments to live on, so a temporary drop doesn't lock in a loss. You simply wait for it to recover. But once you're retired and withdrawing from your investments regularly, a market downturn combined with ongoing withdrawals is a completely different problem. If you're forced to sell shares at a lower price just to cover your monthly expenses, you're locking in losses permanently. You're selling low, precisely when you shouldn't be. This is the single biggest risk retirees face that people rarely explain clearly, and it's exactly what the bucket strategy is designed to prevent. By keeping 1 to 2 years of expenses in cash and several more years in conservative investments, you give your growth investments in bucket 3 the breathing room to recover from downturns without ever being forced to sell them during a bad stretch. A simple example to make this concrete. Let's walk through a simplified example. Imagine a retiree with $400,000 in total retirement savings. Bucket 1, the cash bucket, might hold around $40,000, covering roughly 1 to 2 years of essential expenses, beyond what Social Security or a pension already covers. Bucket 2, the medium-term bucket, might hold around $160,000, invested conservatively in a mix of bonds and stable assets, designed to cover years 3 through 10. Bucket 3, the long-term growth bucket, holds the remaining $200,000 invested for long-term growth, since this money won't be needed for a decade or more. Every year or so, this retiree reviews their situation. If bucket 1 is running low, they pull some funds from bucket 2 to refill it. If bucket 2 starts running low, and the market has had a reasonably good stretch, they move some funds from bucket 3 down into bucket 2. The exact amounts and timing shift year to year based on actual spending needs and market conditions, but the structure itself stays consistent, giving this retiree a clear plan instead of a constant source of anxiety. Common mistakes people make with this strategy. The first mistake is keeping way too much money in bucket 1, out of fear. Some retirees uncomfortable with any market exposure keep 5 or even 10 years of expenses sitting entirely in cash. The problem is, cash sitting idle loses purchasing power to inflation every single year. Too much caution here quietly costs you long-term growth you could have otherwise captured safely in buckets 2 and 3. The second mistake is refilling bucket 1 on autopilot, regardless of market conditions. For example, always pulling from bucket 3 every January, regardless of whether the market is up or down. A better approach is flexibility. If bucket 3 had a strong year, pull more from it. If it had a rough year, lean more heavily on bucket 2, or even stretch bucket 1 a little longer, giving bucket 3 time to recover before touching it. The third mistake is setting this up once and never revisiting it. Your spending needs change. Healthcare costs shift. Social Security adjustments happen. An annual review, checking each bucket's balance against your actual needs and adjusting the boundaries slightly, keeps the whole system working the way it's supposed to, rather than becoming outdated and misaligned with your real life. What to do if you're just getting started with this? If this is the first time you're hearing about the bucket approach, don't feel like you need to restructure your entire portfolio overnight. Start by calculating your actual essential monthly expenses and figure out what 1 to 2 years of that looks like in real dollars. That's your target for bucket 1. Then take a look at what you currently have sitting in cash versus what's invested and see how far you already are from that target. From there, a fee-only fiduciary financial advisor can be enormously helpful in structuring buckets 2 and 3 appropriately for your specific situation, your risk tolerance, and your overall retirement timeline. This isn't a strategy you need to build alone or guess at, but understanding the framework yourself means you can have a much more informed, confident conversation about how your money should actually be organized. The bigger picture. Here's what I want you to really take away from this. Retirement isn't just about how much you've saved. It's about having a clear plan for how that money gets used year after year, without panic, without guesswork, and without being forced into bad decisions by market timing you can't control. The 3-bucket plan isn't a complicated formula. It's a simple, logical way of matching your money to your actual timeline. Short-term needs in cash, medium-term needs in stability, long-term needs in growth. That structure alone is what allows so many retirees to stop checking the market every single day out of fear, because they know exactly where this month's grocery money is coming from, regardless of what happened on Wall Street yesterday. If this gave you a clearer way to think about your own retirement savings, follow along, because I share practical, real-life financial strategies made specifically for people building a secure and confident retirement. And tell me in the comments, is your retirement money currently organized this way, or is it all sitting in one place? Let's talk about it.